Hi, I'm Jim Yent from Golden Years Advisors, and our practice is all about dealing with the things that matter in your life, your family, your retirement, your passions, and the things that you can control to make those things better for you. That's what we're all about, and that's what we focus on. Well, this is the second part of our Kickoff series, the first one being the top 10 predictions of what's important for the market in 2019. This is our second one, which is taking a deeper dive into that material. And we're calling this presentation today Globalization. We took it right off the cover of the January 24th The Economist issue because we think it's the apt way of describing what's a big challenge to whether the markets perform well or not in this coming year. As always, we are Jim and Teresa Yent. We are investment advisor representatives, and we clear through our broker-dealer, which is USA Financial Securities. Golden Years Advisors is not affiliated with them in any way.
Once again, we're coming to you from what we jokingly call our Cozumel office. In January, we're always here for 1 to 2 weeks, doing a lot of market research, strategy research, and getting updates from over 30 different strategists and vendors on the outlook for the coming year. And I take it all in right here from this seat, from this vantage point, so that we can process it and develop a plan going forward. Normally, when we're doing our state of the market presentations, we're using material from JP Morgan's Guide to Markets. But today our intention is to try to take a deeper dive. So as a result, we're using information from one of our analytic providers. It's from the NASDAQ's subsidiary for analytics, Dorsey Wright. And on January 30th, we sat through a call with a couple of their analysts who we know pretty well and enjoy their materials. So we thought that would be our starting point for trying to give you a deeper perspective on how we feel the currents are shifting as 2019 begins and how it may develop over the coming quarters. So from an agenda perspective, here's what I hope to do. As always, we are still going to give that big picture outlook. And we've always done that regardless of the source by describing what's happening in both the economy and markets from a growth, typically GDP, profits, S&P 500 profits, unemployment, market valuations, any inflation or interest rate things that are going on with the Feds to give the big macro outlook. But today we're going to dive a bit deeper since a lot's gone on in the last 30, 60 days in terms of market turmoil. We wanted to try to turn the covers a bit so you could see what's been going on and what we've been doing and what several strategies have been trying to do during that time period. And then we want to wrap it up with a discussion of risk that were out there and continue to be out there so that we can have a good perspective for the coming year. But first, I wanted to focus in on something a bit different. We always try to tell our clients to keep your politics separate from your investments because often our feelings about politics can muddy our feelings about investments, and it's usually not productive. But something occurred recently, and it doesn't occur that often, and so we're calling it presidential market timing. We all know it's very bad to time the market. It's very difficult to time the market. If you get it right, hooray for you, but more times than not, that isn't going to happen. But it's rare that a president steps out and tells you, I think you should buy the market. And here's a chart of those couple of times that we can recall that it's occurred way back even to the 70s when Nixon first did it. Reagan was famous for doing it in the mid 80s. President Bush did it once, and even Obama did it once. And in general, presidents seem to have just great market timing. Maybe they know something we don't know, or it's just the power of the office. But recently, President Trump, during the market correction that occurred, said, I think this is a really great opportunity to buy. Now, the jury's still out. We've only been 6 to 8 weeks since that call, but the market surely has rebounded pretty significantly since then. Okay, so as we begin to discuss the economic data, we have to begin from the outset by saying in many ways, we're flying blind. We're flying in the dark because of the government shutdown. A lot of economic data wasn't published in a timely manner, most specifically GDP. So the last GDP we have is from in late December, which just showed that the third quarter economy slowed to, like, instead of 3.5% economic growth, to about 3.4. But we should have had several reports, including fourth quarter's GDP, published in January, but the shutdown stopped it. So we have to just admit, in one sense, there's a lot of uncertainty just because we don't see data. That being said, when we look at what data we do have, it has been strong. So one of the things we've had, because it's not published by the government per se, is the leading economic indicators. And if we were to focus in on leading economic indicators, as long as you're above the zero line, the economy's in a expansion. You might have some dips along the way, but we're a long way from zero is the first message we want people to realize. We may be decelerating, but we're not at zero. So we're going to zoom in on two charts, one showing, when you're at zero, what happens, but given where we're at, how does the market typically perform? And it's still a good story. So let's begin our whole discussion about a deeper dive into the economy and the markets with a basic focal point. If the economy does not go into a recession in 2019, namely the expansion continues and growth continues, equity markets will probably perform all right, the way they normally do during economic expansions. If the economy does fall into a recession, then yes, it's probably the trumpet sounding the next bear market. So there's a lot of different things that we watch to see if we're heading into a recession. One of them is the leading economic indicator. Others are yield curves and some of the things that we're going to talk about. None of them at the moment are indicating that a recession is about to happen. So let's focus on the first one, leading economic indicators. Well, once leading economic indicators do get to the zero mark, things do get rough when it comes to markets and the economy. But we are a long way from zero. So if we look back over the last 30 years, these are when the LEI, leading economic indicator, went negative, went below zero. What happened to the S&P over the next 1, 3, 6, 9, and 12 months? And it was about a coin flip. About half the time when we went to beneath a negative leading economic indicator, markets fell, and about half the time they expanded. So it's not a great indicator just when you get to zero. It takes several other things to confirm it. The point of why we're sharing this is right now we're nowhere near zero. The leading economic indicators actually been above 5, and then it's going to drop and get lower over time. And from where we are now, if you look back over that same 30-year time horizon, there's been 5 times that it's fallen to just beneath that 4-ish level. And in the year that's ahead of it, we've had positive results. The worst case was back in July 2015, if you recall. We had a rough 6, almost 9-month time period before it turned around. But in general, an expansion continues, bull markets continue. So to us, we haven't seen signs yet that we should be running for cover. In a similar vein, when a recession is approaching, we usually see unemployment claims start rising. And as you are well aware, unemployment is at 50 to 60-year lows. We were down at 3.7. We temporarily have popped up a bit to 4, but the last jobs report was a huge number, over 300,000 new jobs we're taking. So it's like people are just coming out of the woodwork getting jobs. So as the graphic here shows, where there's a gray bar, that's where a recession occurred. So these gray areas are where a recession occurred. And always prior to that, we usually see unemployment claims rising. Well, it's just not happening yet. It may still happen, but at least at this juncture, all looks well. A second thing we often use to help us get a feel of what's the odds of recessions coming is the yield curve, which is the angle of interest rates from the shortest term rates, namely a 3-month treasury bill, all the way out to a 30-year treasury. But most people focus on the T-bill, the 3-month, out to the 10-year treasury. And without a doubt, that's getting tighter and tighter as the years have progressed, so that we are, just a quarter point or less from inverting, namely the longer part of the curve has a negative slope compared to the shorter point of the curve. And in fact, last year a lot of press was discussed when the 2-year versus 5-year portion of the curve inverted. But the whole curve as a whole has not inverted. It's gotten very, very flat. So what I like us to do is real quickly zoom in to kind of historically where we're at right now, so that we can see, yes, yield curves is one of those indicators, but it's usually multiple quarters, if not a year, in advance of a recession, and that markets still can do awfully well given where the yield curve is at. So now we've zoomed in on the bottom part of that curve, and as I told you, it's under a quarter point now. We're about 0.15 is what that yield curve has been of late. And what we've done is we've looked, and we're going back now almost 40 years, all the various times when yield curves got to this point, what happened on the next 1, 3, 6, 9, and 12 months. And you'll see prior to inversion, the average is a year out, double digit type returns with a min and a max. And it's always been 100% positive thus far. Past performance doesn't predict the future, but that's how it's been. So we're watching this yield curve to see if it does invert, and invert consistently, not just for a mere moment or two, a day or two, or not just a portion of the curve, but the entire yield curve. If it inverts, that is a significant thing for us. We're tracking it, we're watching it, but as of yet hasn't occurred, and from where we're at, there still could be good gains to be garnered. So this is why this deeper dive presentation is entitled Slowbalization. Yes, absolutely, at some point there is the next recession and there is the next bear market. And like some would argue, 19.9% fall, we're splitting hairs to not call what occurred in the fourth quarter a bear market. But the real challenge for investors going forward is, if this economy, not just in America but across the globe, if this does not head into recession, if it's just a slowing down of global growth, then markets typically grind higher. So let's talk about that. To reinforce this idea that growth is slowing down, let's take a look in on the profit and earnings side. This comes from our friends at Zacks Research. And after last year's tax changes and cuts, which dramatically boosted profits, third quarter and for a rolling 4 quarters, S&P 500 profits were up well over 20% in the green bar. And here in that orange bar, on a rolling 4-quarter basis, revenue itself was growing over 10%. Contrast that to, the numbers aren't final, we got approaching 40% of the S&P as reported on a market weight basis. It's shrunk down to earnings in the teens and revenue growth in the mid-single digits. And that's what we're faring, and it'll probably continue to decelerate as this year moves forward. So be prepared for a first quarter. I mean, it's not April yet, but when we do earnings in April, first quarter could be relatively flat. It historically hasn't been one of the better quarters. But in any event, our fourth quarter numbers still outpacing the last 3 years on both a profit as well as revenue basis. And as we look forward, earning estimates late last year were actually in the double digits, and we've seen on a month-by-month basis those estimates are actually coming down, so that now we're actually seeing things in the middle single-digit numbers as the consensus estimate for S&P 500 companies' profits will be on a full year basis. More reasonable, still growth, not recession, but growth. This is the fundamental question. If we have economic growth, markets, although they could be volatile, usually grind higher. So where are we? This is from Ed Yardeni of Yardeni Research, who is a very trusted market pundit that we've been following for several decades now. And what you see pictured here is any place where you see the pink zones, that's where there was actual bear markets, where the market fell over 20%. For instance, the Great Recession or mortgage meltdown, 2007 through 2009, where we fell over 50%. And every other blue area is where we had either a mini correction, a 5 to 10% pullback in the market, or a true correction, a 10 to just under 20% correction in the market. And as you can see, we have had over 10 of these. I think we're on 12 to 13 and counting in the last decade. And some of the more dramatic ones, of course, being in 2011 when the Standard & Poor downgraded the U.S. Treasury bills, or back in August of 2015 when the yuan, Chinese dollar, fell a bit, and then our ugly beginning to January of 2016, the worst in S&P history. But more recently, that was our fourth quarter sell-off right to that 20%, not quite bear market line. So during this entire economic expansion, that's what the market has done, with a long period of just really low volatility with these outbreaks now and then, and we just had an outbreak. So that's why the question is so key. If the economic growth continues, even at a slowing down or a deceleration, but long as it is growth, markets tend to grind higher and recover from these corrective periods. So what might this correction look like, and what have corrections in the past look like? This is a chart that we've shared many times. We're going all the way back to the Great Depression, 1928, forward, and every green spot that you see going back those 90-ish years shows you how far the market fell in any given year. But if the blue lines are above the origin point, above the 0 point, even though there was some pretty big declines during the year, 68 to 70-ish% of the time, markets are up rather than down. That's just the historical facts of the situation. But there are periods of very deep declines. Like I said, the Great Depression, this was during the 70s where we had multiple big declines. That was our more recent tech bubble, our mortgage meltdown. And then last year was a down year also. So with all of those, both bear and corrective markets, what we have on the side is here's how the typical recoveries would proceed from that. So let's zoom in on that. The historical numbers, if we focus back to all those times when we had either bear markets or corrections, is however deep the drawdown was, and that's what we're seeing in this column here, however deep the drawdown was, how many months from 1 month, 3 months, 6 months out to a full year before we finally ended up either positive or negative. And not all times were positive. We had a couple of times, specifically in the 70s, 12 months later, we were still negative pretty significantly. And also during during the tech bubble in 2001, 12 months later, we were still negative. But on an average basis, usually double-digit recoveries about 3/4 of the time. So what makes us think that this might be a recovery that's beginning now? Let's dive in on that. To be fair, again, no one knows because none of us can predict the future. Whether the fourth quarter correction is over because we are recovering, but we're still not back to the market high we had. But to show you how deep that and quick that correction was in the fourth quarter, I want to share 3 to 4 charts. And this is definitely a deeper dive than we've normally done with y'all. This is from the New York Stock Exchange. They have something called a high-low index, and I don't expect you to be able to read this chart. You'll see how I'm using it in a second. But what the high-low is how many stocks on a rolling average basis were hitting new highs versus how many were hitting lows. And when markets are very buoyant and are almost at an overbought level, this chart will tend to be up in the higher ends of the spectrum. And when things are really bad and depressing, you'll see them at the lower levels. And once again, I'll expect you to read this. I just want you to be able to see right here, we were almost at zero during the fourth quarter. That's how depressed from a sentiment perspective the market was. And to give it some kind of perspective, it was at least as deep as during the mortgage meltdown time period. So although we didn't fall 50% like the markets did during the Great Recession and the mortgage meltdown, from a sentiment and from just a shock value, it sure felt like that is the message you should probably take away from this as we are starting to rebound out of it. And if I'm going to be a bit geeky in this deeper dive, that high-low index, being beneath a 5 on the score, right around the 0 point, doesn't happen often. We're going back over 30 plus years, and what you see in front of you is the 6 times that it occurred. And 5 out of the 6 a year later, that's what you're seeing. What are the returns of the market 3 months, 6 months, 9 and 12 months later? 5 out of the 6 times they were positive, and pretty strongly so, with one exception. It was our good old Great Recession there. So that's one thing that we're watching to see, is this that 2008 fake out, or is this, like the majority of the times, taking off to some newer highs? Here's a second way we're diving deeper. Like the high-low, this is called the advancing declining percentage. And yes, it can get pretty sold off. On this chart, you can at least see, we like to think of between the 30 on the bottom, rather than a true 0 point bottom, and 70 on the top are the extremes. And you'll see that we've circled several places on the screen where after a deep decline down into a 30 very sold off position, it bounced back as high as exceeding the 70 percentile. That doesn't happen often either. This is the last 50 years, and you can see that too has happened about 6 times. Let's see what that has meant. So we've seen this occur now for the 6th time. That means we have 5 data points of history over the last 50 years, and that's what you're seeing right in front of you. These 5 times in the past, we're in the 6th time. It's occurred from very extreme pessimism to incredibly strong and quick bounces back. And 4 out of 5 times, they've been positive results. One wasn't. It was actually positive for the most part, and then towards the end, it gave some back. But this is what we're watching to see what develops after such a strange fourth quarter. It's rare to see a December so ugly, but now a January, February so strong. So putting it all together, where does this lead us to? Well, we're not back to the market highs at the end of the third quarter, as this chart indicates. We've recovered some from our fall, but there is more to go. And if we look at a valuation basis, this is really looking at the price earnings ratio. How expensive or cheap the market is. Heading into the correction, the market was getting pricier, but now we are at long-term averages. So if anything, from a valuation perspective, it encourages us that we probably have some upside in front of us. Or to be more specific, the PE ratio contracted last year at not historic levels, but at pretty significant levels. What you'll see here is how many notches of contraction can occur. And we were above the 20s, we were in the mid 20s from a PE basis and shrunk down to about 16. And there's been 4 times only in the history of the market that it's shrunk more, and we're kind of really a dead heat. So it's really a tie for 4th. But we contracted over 5 notches. There is some room now just for expansion of PEs. For our clients who have been with us for a while, you know that we're not biased to any one factor, whether it be growth or value. Some people think it's momentum or quality. It's really none of the above. It's a relative strength. Which one of those factors is working at any given moment? And for the past 3 years, far and away, domestic equities have outpaced international and emerging markets. And so we keep track of this, and what you see here is a chart that shows not only where we were at the end of the year, so right here at year end, domestic equities, if we were to divide the investable universe into 6 big buckets, domestic equities was first, international equities was second, commodities, fixed income, cash, etc. Now for the year, to be fair, cash outperformed everything on a full year basis because equities, both domestically and internationally, commodities, and for the vast majority of fixed income investments were all negative investments on a calendar year basis. Only cash was positive. So that's how ugly that 4th quarter sell-off was. And if we were to look over the decades, the last several decades, it's been pretty dominant how strong domestic equities have been. In the 90s, it was true. Not at all true in the early 2000s. Far and away, international equity was the place to be. But in the 2010 thus far through 2018, domestic equities have been even more dominant. We're pointing this out to you because it remains true today. At some juncture, it has to flip. Everything flips and mean reverts. So we have our eye focused on this, and what usually makes it happen is when the US dollar goes from a strong dollar to a weak dollar. So no one can tell you when that change will occur, but when the dollar is strong in a rising dollar market, it is US equities, small and mids and growths that tend to be dominant. We've gone quite a while with the dollar strengthening. If that were to change this year, and it has a high probability, we can't guarantee anything, but if we get a weaker dollar, a falling dollar, means we're going to have to look abroad. So one of the discussion points when you come in for quarterly reviews is we're preparing you for us being nimble enough that if we see that occurring, that you're comfortable with us making those moves to non-US equities, to sectors that perform better in that type of environment, such as basic materials, energy, industrials, things of that nature. Why are we sharing this at this moment? Because we've literally seen that change already occurring and getting to the point that we're now very interested in doing some non-US investments. So we're looking at the emerging market group, and we do a lot of technical ways of saying, is it safe enough to get back in the water? And basically what you see us pointing out is the tide is turned. It's starting to look attractive. We're not ready to jump out in the water, but when you come in for your reviews, we're going to be talking about, and you're already seeing it in some of our portfolios. We have positions in Brazil and other places where there's stronger and better opportunities in limited ways outside the US. I'd like to wrap up this deeper dive, and I'm sorry that it's gone so long, with just a few comments on risk. What you see in front of you is the exact same set of risks that we identified 90 days ago on our fourth quarter state of the market. And the only thing that's really changed, and that's why you see a line through it, is at the end of the third quarter, we clearly had what I would call excessive optimism. Well, I think it's pretty safe to say the ugliness of the fourth quarter kind of shook that all out of us. If anything, there's a lot of pessimism and fear that in the hearts of many of the investors. But a lot of the same things are still remaining. We had the discussion then about what we called the bear traps, and we said we don't see any yet, but we continue to monitor them. But the discussion is what we've already reiterated earlier in this presentation. The risk of recession is the fundamental question. We're slowing, but as long as we keep growing rather than going negative in our growth, markets usually do all right. We're monitoring all the other things that you see below. Rates, if anything, with the Fed's recent meeting, they've signaled that they're going to be a bit more patient. They've changed the language of their statements, saying that they feel that both inflation is under control and that they can, in essence, pause for a bit and just monitor things. The way they keep saying it is they're data dependent. They're just going to wait and see what happens and then react to it. Other things are potentially getting worse. Political risk seems to be accelerating with government shutdowns and red blue states and Brexit and Italy, etc., as well as debt levels here and in other places in the world. Trade war, if anything, we've had a little bit of a reprieve. So risk, it's still out there. And as I open the meeting, the level of uncertainty, it almost seems like there's more potential things in each one of these areas that could go wrong. All anyone can do is be proactive and monitor them as we go forward. And that's what we're doing for you. Well, I'm going to call it quits at this point. We had a couple more slides, but we went way over our time. I hope for those of you who like the more detailed message, this scratched your itch. We're trying this as a way to get it out to those folks who keep requesting it. 30 minutes is probably too long, so we're going to have to do something about that. But that was our inside scoop on what we're monitoring and watching to see which way the year breaks. I'm sure this can raise questions. Anyone wants a copy of the slides, just give us a call. Come on in for your review. If you're new to golden years and you've never heard this type of discussion before, please, schedule some time with us. We'd love to chat. In front of you is the disclosures, as always, and we look forward to seeing you soon. God bless.